Good morning. I'm Gary DeWaal, and this is Bridging the Week for June 4th to 8th, and today is June 11th, 2018. The Commodity Futures Trading Commission proposed to leave good enough alone and not decrease the swap de minimis threshold from $8 billion to $3 billion as of year-end 2019. Additionally, the CFTC proposed to exclude from the definition of swap dealing hedges of both physical and financial positions, as opposed to just physical positions now, and asked whether executed and/or cleared swaps should also be excluded. Also, the Joint Audit Committee issued a reminder regarding the do's and don'ts of handling omnibus accounts. But why now? The days are almost at their maximum yearly length here in New York City, so I may get outside and enjoy the sunshine as long as possible. Let's get started. The Commodity Futures Trading Commission proposed rule amendments that, if adopted, would maintain the current swap dealer de minimis level at $8 billion as opposed to reducing it to $3 billion at the end of 2019. In addition, the Commission proposed to exclude certain swaps from inclusion in the calculation of the swap dealer de minimis level. These would include certain swaps entered into by an insured depository institution in connection with originating a loan under more flexible standards than currently prevail, and swaps to hedge financial or physical positions as opposed to solely physical positions as currently is the case. Conditions would apply to both exclusions. Under current CFTC rule, a swap dealer includes any person that holds itself out as a dealer in swaps or engages in an activity commonly known as a dealer or market maker in swaps, makes a market in swaps, or regularly enters into swaps with counterparties in the ordinary course. However, a person is not considered a swap dealer if, during the prior 12 months, it has not entered into swaps with an aggregate gross notional amount of greater than $3 billion. However, this $3 billion level was subject to a phase-in amount of $8 billion that initially was set to expire on December 31st, 2017, and through two CFTC orders has been extended through December 31st, 2019. Swap dealers are generally subject to a host of internal and external business requirements. Ancillary to rule changes, the Commission sought comment on whether it should add minimum dealing counterparty or transaction count thresholds to its de minimis exception, as well as whether it should exclude exchange-traded and/or cleared swaps, as well as non-deliverable forward transactions from the calculation of swaps counted against the de minimis level. Generally, the Commission supported its rule amendments proposal by pointing to statistics showing that the current $8 billion threshold captures almost all swap transactions, and that lowering the threshold to $3 billion would only subject a small amount of additional amount of swap activity to swap dealer registration and could lead to quote-unquote reduced liquidity for non-financial commodity swaps. This could negatively impact end-user and commercial entities who utilize swaps for hedging purposes, alleged the Commission. The Commission, which voted 2-1 to propose the rule amendments, with Commissioner Ralston Benham dissenting, will accept comments to its proposal through 60 days following its publication in the Federal Register. The Joint Audit Committee, a representative committee of U.S. futures exchanges and regulatory organizations, issued guidance regarding the handling of omnibus accounts by Futures Commission merchants. Generally, omnibus accounts are accounts of other futures brokers carried by an FCM that contain the positions of more than one undisclosed customer. However, omnibus accounts may contain the position of a single undisclosed customer. As reminded by the Joint Audit Committee, carrying brokers are reported to report open positions of omnibus accounts on a gross basis, although they can close out offsetting positions of the same customer upon receipt of written instructions. An FCM may also set up omnibus accounts with only one customer to automatically offset. However, said the Joint Audit Committee guidance, quote, the FCM must maintain written evidence and regularly confirm that the omnibus account is solely for one underlying account owner, end of quote. The minimum initial margin level for omnibus accounts is the maintenance margin level at the relevant exchange. FCNs may apply a higher margin levels, however. If an omnibus account fails to meet a margin call by close of business T+2, the carrying FCN must take an under-margin capital charge. FCNs must notify their self-regulatory organization, or if notified by their SRO, the National Futures Association, within 24 hours. If margin call is satisfied in anything other than good funds. According to the Joint Audit Committee, customer and house omnibus accounts of the same futures broker must be separately established and reviewed. Why was this advisory issued now? Check out the online version of my blog this week and last week at www.bridgingtheweek.com and review the article about the CMA Group's summary suspension of Hana Financial Investment. Maybe these two events are related. Maybe highly likely. Well, that's it for this week's edition of Bridging the Week. As always, there is more information in each article and more articles on the article version of Bridging the Week on the website. That's www.bridgingtheweek.com. Check it out. I'm Gary DeWaal. Have a great week, and until the next edition of Bridging the Week, ciao!